Welcome to today's deep dive. Our mission for this session is to map out the exact step-by-step transition from, merely saving your money to actually building lasting wealth.
Right, which is huge.
Yeah, and we're going to unpack how to do that without that underlying anxiety that usually accompanies the stock market.
Because that transition from saver to investor is this massive psychological leap. I mean, a huge portion of the population simply never makes it. So mapping that out is arguably one of the most high-value exercises we can do.
Completely agree. To guide us, our source material today is a really practical financial guide by a creator named Jack. It's laser-focused on dismantling the barriers that keep people stuck in a savings-only mindset.
Yeah, it breaks it down so well.
So let's talk directly to you, the listener. Picture a scenario that is probably going to feel, well, a little too familiar. You spent the last few years doing the quote-unquote responsible thing.
We're being disciplined.
Exactly. Every single month, you automate a transfer of, say, $100 or $200 from your checking to your savings account. You feel financially mature. But then you log into your banking app and you see that your savings account has finally crossed the $10,000 mark.
Which is a massive milestone.
It is. But sitting right next to that $10,000 is the yield, a 0.5% interest rate.
Ouch.
Right. That means after an entire year of ironclad discipline, your money has generated a grand total of $50.
Yeah, a mere $50.
Meanwhile, your feed is flooded with talk about asset allocation and compound growth and market returns, and you're left staring at that $50 yield wondering, wait, am I doing this completely wrong? Okay, let's unpack this, because we really need to dismantle this pervasive illusion that a large savings account is synonymous with wealth.
Yeah, that realization you just described, that is often the exact catalyst for people. We're all broadly conditioned to view the act of saving as like the finish line of financial responsibility.
Right, like you've won the game.
Exactly. But Jack's guide immediately draws a hard, functional line between the purpose of saving and the purpose of investing. Saving is a defensive mechanism. Its entire job is just to protect your money from immediate loss.
Okay, so it's a shield.
Right. And investing is an offensive mechanism. Its job is to grow your money. So using a savings account to build wealth is fundamentally using the wrong tool for the job.
That makes a lot of sense.
Yeah, it's like trying to chop down an oak tree with a butter knife.
I love that visual. We should look at the raw math to prove why relying on defense alone just mathematically guarantees you'll fall short. Let's take that $10,000.
Do it.
Even if you optimize it and move it into a high-yield savings account earning, say, 1%, after 1 year, you have $10,100.
Right, so you successfully protected the principal, the money is intact, and you got a nominal fee for letting the bank hold it.
A very nominal fee.
Yeah. But adjusted for basic inflation, you have likely lost purchasing power. The capital hasn't grown, it has just barely survived.
Now we map that against investing. If we take that same $10,000 and place it into the market, and we look at the historical long-term average of the S&P 500, we are generally modeling a 10% annual return.
Which is the historical average, yeah.
Exactly. So after 1 year, that investment yields $11,000. Looking at a single 12-month window, the difference is $100 in savings versus $1,000 in investing.
Right.
It's a notable difference, but perhaps not a staggering, life-altering gap that forces someone to immediately change their behavior.
And what's fascinating here is how the human brain completely fails to intuitively grasp the mechanics of what happens next. We are fundamentally linear thinkers.
What do you mean by linear thinkers?
So our evolutionary environment rewarded linear cause and effect. Like,
Huh.
I forage for 1 hour, I find 1 basket of berries. I forage for 2 hours, I find 2 baskets.
Right. 1 + 1 = 2, consistently.
Exactly, day after day. Our neurology is simply not wired to comprehend exponential compound growth, where the curve starts flat and then just aggressively accelerates upward.
Oh, wow.
So when people look at year 1, their linear brain evaluates the friction and thinks, is the extra volatility really worth an extra $900?
But that linear bias completely shatters when we zoom out to 20 years, because the math gets wild.
It really does.
That $10,000 sitting in a savings account at a 1% return for 2 decades becomes roughly $12,200. You deferred gratification for 20 years to generate $2,000.
It's almost depressing.
It is. But taking that identical starting capital and leaving it invested at a 10% average return transforms it into roughly $67,000.
Right. Same starting money. Wildly different financial universes.
If the math is so clearly in favor of investing, why are we all conditioned to just celebrate hitting a basic savings goal? Are we practically trained to accept pennies?
Honestly, yeah. The source material drives this point home aggressively.
Hmm.
The biggest wealth gap in modern society isn't between the people who save their money and the people who spend it recklessly.
Wait, really? It's not the spenders.
No. The real chasm, the one that dictates who retires comfortably and who works indefinitely, is between the people who save and the people who invest.
But the culture pats us on the back for locking our capital in a digital vault where it essentially just suffocates.
The conditioning is powerful. But the root cause of why people stay stuck in savings isn't a lack of mathematical understanding. It's a psychological hurdle. We are dealing with human biology here.
Because saving feels safe.
Exactly. It caters to our need for certainty. You look at your screen and the number is static. It does not drop by 5% on a random Tuesday afternoon. It gives us this illusion of absolute control.
Whereas investing forces you to confront emotional volatility. The numbers fluctuate based on global events you have zero control over.
And that fluctuation triggers a deeply ingrained survival response. When people see a number tied to their livelihood dropping, their amygdala just fires.
The lizard brain takes over.
Right. We are evolutionarily wired to panic when our resources appear to be dwindling. If you see your portfolio drop by $500, your rational brain might know it's a normal market fluctuation. But your lizard brain is screaming that winter is coming and the food supply is rotting.
Wow, so it's a literal survival instinct.
Yes. The fear of losing hard-earned savings is the primary reason most people never make the transition. People conflate safety with stagnation. A savings account is safe from daily volatility, but it is highly vulnerable to the silent erosion of inflation.
So saving is like parking your car in a locked garage. It's perfectly safe, but it goes absolutely nowhere. Investing is driving that car on the highway. You'll actually reach your destination, but you have to learn to tolerate the traffic and the bumps in the road.
That is a brilliant way to put it. The tragedy is that people are so paralyzed by the concept of highway traffic that they spend their entire adult lives sitting behind the wheel inside a locked garage.
And they're deeply confused as to why they haven't arrived at financial independence.
Precisely.
To get the car out of the garage and confidently merge onto that highway, we need a seatbelt. We need some emotional insulation.
Which brings us to the first two steps of the guide.
Right. Jack's guide lays out a protocol for building that safety net, and it fundamentally relies on establishing a rigid cash buffer before you ever touch a brokerage account. Step 1 is building a real emergency fund. 3 to 6 months of basic living expenses held purely in cash.
This cannot be overstated. The cash reserve is the foundational layer of wealth building, and the source material is adamant that this capital is dead money.
Meaning you don't invest it?
Right. It is not waiting to be deployed into the market. It's not dry powder for a sudden opportunity. It serves one singular purpose: mitigating life's inevitable catastrophes.
Job loss, a major medical event, or the transmission falling out of your car?
Exactly. The logic here is reverse engineered from how people lose money in the market.
What do you mean?
Well, the primary reason amateur investors panic sell and lock in devastating losses is rarely because they suddenly formed a complex macroeconomic thesis about global markets.
Right. They aren't financial analysts.
They sell because their car broke down, they desperately need liquidity, and all their capital is tied up in equities during a downwink. The emergency fund protects your investments from your own life.
So what does this all mean? Is an emergency fund basically just psychological insurance against our own panic?
Absolutely.
Right.
Which leads to step 2, separating the money mentally. You create 2 buckets. Bucket 1 is your safety money, that immovable emergency fund.
Okay, the do not touch bucket.
Right. And bucket 2 is your growth money, which is the capital actually deployed into the market. By physically and mentally segregating these funds, you are actively giving the growth money permission to fluctuate.
Because you know you don't need it to fix the car.
Exactly. If we connect this to the bigger picture, you are utilizing a foundational concept in behavioral economics known as mental accounting. Humans do not treat all money as fungible, even though mathematically a dollar is a dollar. By strictly categorizing our capital, we bypass our own emotional roadblocks.
That makes so much sense. When all your net worth is pooled in one place, any market dip feels like a direct threat to your ability to pay rent next month.
Yes, but with mental accounting, A temporary drop in your growth bucket doesn't trigger the amygdala's starvation response because the brain knows the safety bucket is sitting right there, fully funded and entirely immune to the stock market. It completely neutralizes the day-to-day anxiety.
Okay, so we have the safety net in place, the seatbelt is on, and the cognitive firewall is built. Now we move from defense to offense.
That hit the highway.
Exactly. We have to actually plant the seeds of wealth. Moving into the action phase of Jack's Guide, the overarching theme is that highly effective investing is remarkably, almost disappointingly boring.
It really is.
Step 3 is simply to start small. You don't need thousands of dollars to begin.
The financial media ecosystem thrives on making the markets seem complex and inaccessible. It creates this misconception that you need tens of thousands of dollars to gain entry.
But brokerages let you start with 50 or $100 now.
Right. Modern infrastructure has eliminated that barrier. The objective in the beginning is not to generate massive profits immediately. The objective is building the habit. Moving $50 into an investment account establishes the mechanical habit.
Habits matter more than timing.
Yeah.
You are building the muscle memory of transferring capital from a safe, stagnant environment into a volatile, growing environment.
Exactly.
Once that habit is formed, step 4 is to keep it simple. And this is the exact moment where so many beginners mistakenly jump into day trading or options or crypto.
Oh yeah, the desire for adrenaline hijacks the process. People want the dopamine hit of picking a microcap stock out of obscurity and watching it triple in value. But the source material is unequivocal here. Highly complicated, high adrenaline strategies mathematically underperform simple, broad market exposure over long time horizons.
So the best move is often index funds.
Yes.
By tracking hundreds of companies in the overall stock market, you completely eliminate the single company risk. You aren't gambling on one CEO, you are capturing the aggregate upward trajectory of the broader economy. It offers diversification, lower risk, long-term growth, and hey, it's recommended by Warren Buffett.
Which is a pretty good endorsement. You are systematically removing human error from the equation.
Then we hit step 5, consistent investing and discipline. The guide models a scenario that is highly accessible. Imagine investing just $300 a month into the market at an 8% average return.
Pretty standard assumptions.
Right. After 25 years, that portfolio yields roughly $285,000.
Which is a great number, but we have to dissect the composition of that final number. Over those 25 years, contributing exactly $300 a month, how much actual physical capital did you pull from your own paycheck?
Here's where it gets really interesting. Your total out-of-pocket contribution is only $90,000.
$90,000.
Right. But the portfolio sits at $285,000. That means $195,000 is pure compound growth. It's like free money. It was working while you were sleeping or on vacation.
That $195,000 is the premium paid to those who master boredom and consistency. But achieving that result requires surviving the ultimate psychological stress test.
The market crashes.
Yes. Economic downturns are a statistical guarantee. The market will contract. The financial networks will switch to aggressive red graphics, pundits will forecast a catastrophic recession, and the broader public will panic and liquidate their assets.
Wait, so when the market crashes and everyone is panicking on the news, we're supposed to completely rewire our brains and treat it like a Black Friday sale on stocks.
This raises an important question about how discipline separates investors from gamblers. Rewiring your brain requires understanding the mechanics of automated buying during a contraction. Historically, markets always recover and eventually reach new all-time highs.
Right. They always bounce back eventually.
So if your strategy relies on an automated $300 monthly contribution, a market crash is a massive mathematical advantage. Long-term investors benefit because those monthly investments buy more shares at lower prices.
Oh, I see. It's like going to the grocery store with your usual $300 budget, but suddenly discovering that your $300 fills 3 entire shopping carts instead of just one.
That is a phenomenal way to visualize it. You are accumulating volume. When the economic cycle inevitably turns and the market recovers, that artificially high volume of shares you acquired at the bottom generates explosive, disproportionate growth.
Because you bought them all on clearance.
Exactly. This is the exact mechanism that allows experienced investors to remain entirely calm during recession. They think in decades, not days.
Jack's Guide closes with an analogy that perfectly synthesizes this entire shift. Saving your money is akin to storing seeds in a glass jar. They are protected, nothing will eat them, but they're dead.
Nothing grows in glass jar.
Right. Investing is the act of taking those seeds and planting them in the soil. Initially, it looks chaotic, it's messy, you have to tolerate the unpredictable weather, but over time, the root system takes hold, the growth compounds, and you cultivate a harvest that dwarfs what you started with.
It's brilliant. One strategy guarantees preservation through stagnation. The other utilizes short-term volatility to guarantee long-term cultivation.
Let's quickly recap the journey for you, the listener. You start by building that 3 to 6 month emergency fund. You mentally separate the safety money from the growth money.
You start small to build the habit.
You buy simple index funds. And you stay relentlessly disciplined through the crashes. Saving provides stability, but investing provides absolute freedom.
The quicker you cross that threshold, the more leverage you gain over your own future.
Stability versus freedom.
That brings us to a final, provocative thought we want to leave you with today to mull over. We've spent this deep dive analyzing the mechanics of compounding, but the absolute non-negotiable ingredient in that entire equation is time.
You have to wait decades for it to work.
Right. So if time is the actual active ingredient in wealth creation, are you just investing your money, or are you actually using your money to buy back your future time?
That completely reframes it.
When that compounding finally peaks, what does your freedom actually look like? Are you finally ready to open the garage door, pull the car out, and navigate the highway?
It's a question worth asking yourself.
Absolutely. Thank you for joining us on this deep dive. We encourage you to look at your own savings account with a completely new perspective tomorrow.